Good morning and welcome to Equity Story Trade Watch, the 25th of January, Wednesday. I'm here with Claude this morning. So welcome and good morning, Claude.
Good day.
We are going to be talking, of course, about some ideas today, the weekly ideas that we've got for you, thought of the week. This is going to be exciting. We're going to actually have pretty similar space that we're going to talk about, but different ideas. So that's going to be quite interesting. But we've got a lot of quarters to go through first, Claude. So I am going to start with looking at some of these announcements and just briefly look at the charts because we've got so much to talk about today. I don't want to go way too long when people just fall asleep. So we're going to look at some charts. And if there's a story to be talked about, we will talk about it, but fairly briefly. All right. Last night, first of all, well, before we go, actually, of course, we just have to quickly mention the Equity Story disclaimer in front of you. General advice only. Everything we talk about, every stock is based on fundamentals and technicals only. All right, let's swap. I'm going to quickly move to the actual chart. So bear with me for 1 second. It should be on right now. So announcements this morning. Our market sort of, I think, started a little bit down on the back of fairly boring day last night on the Nasdaq and Dow, but I like some of these moves still for the week because we're in a quarterly season. There's a lot of information coming through, and some of this information is actually not bad. We've been looking actually at some of these quarterlies, and they definitely give you a bit more hope that there's more good times to come on some of these stories. So let's start. I'm going to start with first of all ILU. And I really don't want to talk about it. I just want to have a look at the chart. They come up with a quarterly, which wasn't too bad. But let's just have a look at what they actually are. You can see the chart's looking pretty good. So technically still a hold. If you're trading this, maybe you look $11 would be your take a profit. Otherwise, you probably hold on and you've got a stop probably just below 10. So that's on Iluka. MIN is the next one, another big one that's come out today. And a lot of you are actually trading this. I quickly want to briefly mention this. It looks pretty good. Of course, there's a profit takers around the usual. We've got $100, a really big bad barrier psychologically, where the traders usually come in and start selling off. The quarterly wasn't too bad, but they've got two good things going for them. Iron ore price is still quite high. Lithium prices are still quite high. However, for me, I think if I'm just looking for the next 3 to 6 months, maybe they've sort of hit their peak at around 100 and might struggle to get through into the 100. That's just my thoughts. Next one, another one where sort of trading, holding, investing for maybe for a little bit longer term. That's West African Resources on the back of some gold prices. And look, its quarterly wasn't too bad from what we can see. It's going to be up and down for it. I think it's going to be more gold oriented. They are developing their new mine, so that's going to take a bit of time. That's going to be actually quite a bit of money as well. But if you look at the quarter, it wasn't fantastic, but overall they did a good job to get within the guidance that they provided previously. So I'm still okay with this. If I'm looking to it, if I'm still on this trade, I'd be looking at roughly 117, 116 to be my get out clause on this one. So I'm still holding on that one. And let me see, one more I want to talk about, and we'll leave probably the rest. So that's AX1. What amazing time, Claude, for the retailers out there. We've seen Maya, crazy, right? Best retail sales for like 30 years, apparently. AX1, look at the chart here. It's just crazy. Again, pretty strong results here. Look, to be fair, on the back of a pretty poor 2022 start, or 2021, 2022 last year, so 12 months ago. So they're really coming off poor seasonality. Now it's much better than previously, and that's good to see. But some of these charts look fantastic. So if you're on this trade, you're probably still targeting that 230, 240. If you've got a stop, you're probably looking at about 195, somewhere around there. Aggressively, otherwise maybe just maybe around that 185 if you'll give it a bit more leeway. All right, so I'm going to move on to some of the stocks you want to talk about, and let's start with SES if we can. And I know I follow it as well. You probably have a look at it yourself. Tell me about SES. What do you think of the quarterly?
Oh, look, thanks, Peter. And look, also thanks for that AX1. I quite like that as a retailer, and it has been a strong season for retailers. Question whether that's going to turn around in the next 6 months. Yeah, look, Secos is a bit of a disappointment, to be quite frank. These guys have a capital intensive business where they are trying to sell biopolymer, essentially. So the recycle or the degradable plastic bags you might get, a lot, especially a lot of bin bags, dog bags, that kind of thing. This quarter they managed like mild operating cash flow positive. They've been downsizing some of their older non-compostable lines, which has freed up working capital. So wouldn't take too much comfort from the result here. They've had a disappointing year. Overall, if you look at their sales, over the last year, their sales are down, including in their supposedly growth biopolymer area. So bit of a problem there. That really bursts the growth narrative for me. And so, yeah, just be a bit cautious of this one.
I agree. Just a quick question for you. Do you think this is a business problem or a management problem?
I think it's probably mostly a business problem, to be honest. I think that Secos Group's always been in a tough business, is really low margin stuff. So obviously little changes can have, big hits to the profitability. These guys have taken a real hit to their revenue over the last year. We see in this quarter, they've managed to keep it cash flow positive. So my gut feeling at this point would be that with Secos, management is fine. It's just a tough business, and you definitely want to be picking it up when it's in a bit of when it's having good times and it's got good momentum, which neither the business nor the share price has good momentum of late.
Fair enough. So I agree with you wholeheartedly with the commentary. We were trading it, we were liking it. Once it broke trend around here, we started getting out, and yeah, we're not touching it for the moment. So that's the way it goes sometimes. It is a tough business, like you say. All right, let's move on to HCO, come up with their quarterly as well. So let's have a look at that one. I actually don't know anything about it, so please enlighten us.
Yeah, so another little one I've followed for years. This one is got a nice little business model in the fact that it has this Expensify. No, it's not called Expensate. Is it product? Its main product. It's got this card hero thing that's sort of a bit more nascent. This Expensate stuff is used by government for a bit of expense management, say travel expenses or whatever else might be. So they have a nice little sort of ticket clipping business model there that's obviously taken a hit in recent years, as there's been a lot less corporate travel and a lot less expenses to manage. So that's their business model. It's but supposedly got like a good amount of growth coming up due to the fact that it's gradually onboarding more and more government departments and government adjacent sort of bureaucrats. So supposedly got growth inbuilt there. Somehow this company just I guess it overpromises or whatever. I had the impression that its growth would be a lot quicker. It's been extremely slow onboarding new government employees. Once it gets there, I'm sure it'll be a decent business. And quite frankly, in this most recent quarter, they did have record revenue, and they did have decent receipts from customers for them, but still they're only just 1.5 million, still cash flow negative at an operating cash flow level. Still, you'd have to say the free cash flow negative outflow of over 600K with just 1.9K in the bank. This is a problematic one. Another avoid with an unsuccessful quarterly for me, even though it has some positives in it.
Yeah, look, chart says so. Avoid. So for the moment, we're not touching that.
This one day I could buy it, just because I do think that the actual core business they're building now is probably going to be worth something reliably, but I'm definitely no rush. I'd love to see a change of gear with this business where they actually become sustainable and don't need to keep raising capital.
Okay. A&D, please.
A&D. Okay. Ansarada definitely much more established than the other couple of companies we talked about, which were just struggled to get a cash flow positive quarter. Ansarada did have a cash flow positive quarter this quarter, which was its second quarter. For the 6 months, it's still cash flow negative though, and it does have $18 million $18.6 million cash, 7 really. So it's got room to burn cash, and occasion, and you sort of see it operating at around break even. But overall, again, with this one, perhaps a little more interested than the others, but the problem is you don't really have any viable growth narrative here at all. So similar problem with Secos, basically, it's not really profitable yet. You're not going to be buying it for its dividend, and its growth narrative is pretty shaky. Last 12-month revenue was flat. I noticed in their announcement, they nonetheless had the title, quite bizarre, really, strong revenue growth, plus 0% versus PCP, up 2% quarter on quarter. That's the kind of thing that's going to make me steer clear of this company, because I don't know what weak revenue growth is as strong as plus 0%. So
I think there's a typo, unfortunately.
Yeah.
But when I thought this is hilarious.
Yeah. Anyway, so
oh my God.
I hope it's a typo. To me, it seems like actually they're just trying to spin ridiculousness.
Strong growth at zero. It doesn't make any sense.
Yeah. Like,
look, technically, again, it doesn't look good. It just needs more pass. And then let's move on to.
I'll segue into my thought of the week then, if you like. So let's look at quickly. MedAdvisor, MDR.
Oh, you didn't want to talk about SDG?
I forgot about SDG. Yeah, let's do that. Thanks.
Okay, let's do SDG. Sorry, one more before we move to our ideas.
A quick run through. Look, SDG wins my award for the company with the most false promise of becoming cash flow break even. This thing's been bumping around of just below cash flow break even for the longest time. It's made its cash kitty last a really long time. Still got 10.8 million there, but I think there's something fundamentally wrong with this business. That it can have, it can be run rating 60 million revenue, and it's like it cannot make even a slim 5% operating cash flow surplus. So, a few years ago, I thought this thing had great potential. Now, just given how much revenue it already has and inability to make a margin, looks like an absolute bad business model to me. I reckon the way this one plays out is, you wait and hope and pray until it gets like a good result, and then on that one good result, you sell it, kind of thing. I think there's something fundamentally wrong.
Get out now. Get out now.
Yeah, I think long term, so some of those other companies we talked about. So for example, you could imagine Ansarada becoming sustainably profitable, but again, it's hardly a great one. And you could imagine. Yeah, look, it just doesn't do it for me. This one's, I can't believe how bad its financial results are, how long it's been saying it's going to, proceed towards cash flow break even, how many acquisitions it's made, still can't get to cash flow break even. Something seriously wrong with that business. I think it must be very tough business, low margin, probably another avoid for me.
I mean, you always have, look, to me, I'm always going to blame the management. I mean, they cannot be not excused out of this. So if you can't run a ship where you can deliver for the shareholders profitability or whatever, you really should look at your position and get someone else to run it, to be honest, especially when you've got enough time to do so.
Anyway, sometimes these companies do go well. So let's look at MedAdvisor.
All right, let's go. Because I know, hang on, segue, like you said, to thought of the week, right?
Yeah, exactly.
So let's start. So you are talking quarterlies, which is great because obviously we're in a quarterly season. So let's talk about some quarterlies and let's pick out some stocks from your point of view. Which one you get excited about?
So I thought, look, let's talk medtech small caps, because that's an area that I like. And obviously I'm thinking about the medtech small caps as the quarters come up. Here we have MedAdvisor, which is really one of the worst medtech ones. Small caps, one of the worst ones out there. But the great news for long-suffering MedAdvisor shareholders is that they just put out an absolute bumper quarter, their best quarter ever, massive cash flow positive, probably going to be cash flow positive for the whole year, I'd say. There's a good chance now, just on the basis of this strong quarter, even though they'll probably go backwards in next quarters. Either way, the chances of these guys being on a sustainable, I don't know if they will be cash flow positive or not. They're saying they're going to be profitable in FY 2024. So don't expect a profit this year, but with this strong quarterly, plus them saying that they're going to make a profit in FY 2024, you have two reasons to believe they may be, and they have a new CEO, by the way, and the old CEO just dilly-dallied. I was really not a fan of how much they were getting paid for how bad their results were long-term. New CEO, new rhetoric around getting to profitability, and then now these new results, definitely back on the watch list. This is probably an investable stock now. So you've got to wait and watch. This is our first good result in a very long time. So you can't say, oh, it's a winner. You can't say it's a great stock, but suddenly it does look like there's a reason to even bother watching it. So interesting there.
So just a question. So I know, Claude, you were quite negative on this story before. So has what you've seen, obviously you're talking about putting on your watch list. Are you definitely changing your tune on this, that this could be a story to?
Yeah. So previously what my problem with it is they were basically never getting cash flow positive. And even though they had, like we've discussed with some of these other stocks, a lot of revenue, tens of millions in revenue, you're like, why aren't you cash flow positive? Like they went and did an acquisition and they raised capital for that acquisition at 16 cents per share. That acquisition was of its main competitor in Australia. So it was a really sensible acquisition because it really sewed up that market for them in Australia. So that acquisition made it interesting to me, but I sort of speculated maybe the bottom's in now. Maybe this is the bottom. Okay. And maybe it is time to buy, but I said no, I'm going to wait until there's cash flow positive, basically, because I don't want to, like, there's been so long of cash flow negative, and even though they have a lot of revenue, they have so many expenses. Basically, their expense control was really bad. I think they still pay, and they paid management and board way too much. I still think they've got a way to, like, for so many reasons, I think that it's like, has historically been run mostly like the beneficiaries have been like employees, some really high paid employees, not delivering at all for shareholders. So really, I still think that's a problem with this business. It's definitely not on my to buy list, but now that it's cash flow positive, I think that, well, at least we might have high paid management that will start delivering, put it that way. So
and I think that
change of view.
Fair enough. And look, I think that sentiment of yours is definitely being reflected on the charts too. So technically not quite there yet. So probably, maybe another month before we start looking at this as a trade at the very least. But I agree with you. And when I saw it yesterday, I thought, wow, that's a surprise, because I was expecting, like we've always talked about, pretty poor quarterlies coming out of these guys, but it's finally looked like pretty good. So you can see the share price starting to move, people getting behind it a bit more. It just needs one more step to get up to these sort of 30 cent levels, getting previously these levels, and then we're probably in for old money.
Well, anyway, I reckon that we'll see what happens, because I think that the next quarterly is going to look a lot worse than this one. So the price might come down a bit then, but still, nonetheless, may have turned a corner there. I mean, the new CEO gives me hope as well. I still think that they overpay their executives, but interesting. Anyway, so that has me looking forward to a couple of the other med tech companies that I own shares in, which are M17, Mac 7 Technologies.
Yeah.
And now these guys probably should have a pretty strong FY 2023. They announced a bit of a contract win in the last month, which is probably why that sort of gap up a little bit there towards the 70 cent zone. And yeah, the short-term outlook for these guys, I'm expecting, based on their recently announced contract wins, I'm expecting a pretty strong FY 2023, second half of FY 2023. So maybe one more for the traders. I do own a little myself, more of as a long-term hold. Long-term, this is hardly the best med tech stock, definitely better than Med Advisor. But, long-term, it doesn't have that much recurring revenue, so it could have its ups and downs. But it doesn't have much recurring revenue. It has a lot of contract revenue. It gets one-off wins and got a good win in FY 2023. Should be a decent year. If they can back that up with another good win in FY 2024, well, I'm sure it can go a lot higher, just on the momentum of the business, basically. And people will think, oh, well, maybe they'll get one every year, which I doubt they will. But let's see. Either way, interesting little one. From a fundamental perspective, I'm expecting decent results from these guys this year. Maybe this quarter won't be great, but should be in the second half of FY 2023, should be a pretty good result.
All right. Yeah, look, I agree. I like this little company. It's on the up for me. And that's where normally we like to invest, when it's on the up. The chart's not quite there yet. It's not that far away, actually, probably a couple of cents or so, right? So yeah, look, we're looking forward to seeing the quarterly. And if it's a good one, we could see this go up pretty to $1 pretty quickly. So we'll see how it goes.
Well,
All right. What else have you got?
Okay. Well, I wanted to actually, I've got one surprise one for you, which I now put in is VHT, Volpara, which I forgot to mention to you previously. But this is part of that medtech basket. And this is another one of they've already reported their quarterly, and this is another one bumper quarter, this most recent quarter. So they've finally got the cost control ticking along very nicely. And they got their cash receipts kept going up because they sort of just had that in train because they'd already signed plenty of contracts, and they managed to reduce their cash their cash expenses because they let off a lot of employees, which is not exactly the best way to grow, but it's a way to grow. And then finally they had some timing of some good receipts, which again, there's an element of luck. They just had a good quarter. And they're expecting those receipts from customers to go down in the next quarter. So they'll be trading with their cash flow closer to break even, probably a little bit below break even in the next quarter. So that's why I'm not buying after these results, because they've clearly said it was a lucky result. I'd probably prefer buy the next quarter is going to be weaker. However, these lucky results, such a big turnaround from previously, we're talking -3 million or more, 3 to 4 million of operating cash flow or free cash flow rather. And now they've got a surplus, and yeah, a bit of luck. They're probably going to go around to break even. These guys are still finally massively on the improve. Look, I'd never completely taken them off my list because I had a feeling that they'd come good originally. These guys have very recurring revenue. So they got that recurring revenue. They always had the ability to cut costs and improve their finances. They finally did it. Great. This is going to be a lot more interesting story now. Going to be a will they, won't they, whether they need to raise capital or not, because they left it a bit to the last minute to cut expenses. They're definitely too slow there. But another one, clearly improving fortunes. You've seen a big rise in the share price just off the back of that quarterly now. If this comes back down, that's the buy for me, probably. Let's see what happens. I'm not making any promises, but where I'm really looking for the opportunity is this comes back down to closer to 60 cents. And maybe after the next quarterly, it will, if that's negative again. And depending on where we are with growth stocks and whether they're hot at the moment or not. So interesting one.
They are heating up, Claude. They are heating up. That's how I can see it.
Final tour of the sector is my favorite, which you like as well, Peter, Alcidion.
Okay.
So these guys, they've never had to do some desperate cost-cutting thing to get to break even. So 10 points to management versus, say, Volpara. Volpara always had the ability to do it, but they had to do, they overexpensed. Then they have to fire people. Not good for morale. Not a good way to run a business. Alcidion, none of that. Yeah, their share price is up and down. That's out of their control. More importantly, they're not doing some massive firing thing. They've not been doing expenses cutting thing. They've just been doing a get the revenue up, hold the expenses down thing. We are seeing them they've crossed over into cash flow break even. They're talking about a bit to positive FY 2023. I wouldn't take it for granted we get a net profit after tax, but I do think that it's also probably a net profit after tax in FY 2024 kind of story. And yeah, I guess you got to remember something like MedAdvisor has very lumpy receipts because it can get a big contract, and also a lot of its business it's not really that deep in the stack. It's sort of that last line of defense that the pharmaceutical pharmacies use to manage their relationship with the client, and then also to push out marketing to the client. So they're really just sitting in there managing the relationship between pharmacies and the clients. In the process, MedAdvisor is getting, doing marketing services for pharmaceutical companies and a bunch of other things there. Alcidion, completely different position in the stack. These guys are the software that hospitals and clinics and hospital wards are using to manage the flow of patients through their hospitals, what tests they need, where are their test results, does the test results need to be actioned, patient electronic systems, all sorts of things. This is deeply integrated business to business stuff. Once you get in there, there's some chance you're not going to get out of there for decades. So yeah, basically like that should be good sticky revenue as long as, you know, it just runs itself and doesn't break. Then in the out years, that should be good profitable revenue for these guys. And, you know, with luck, they can consolidate their position and just keep growing and growing there in that very healthy business to business area. What you do want to see is them get profitable, which they are on track to do. So these are my favorite own shares in these. Still like them right now today as we talk.
All right, so that obviously that's your number one position there.
In the med tech stocks right now, I reckon Alcidion's the best opportunity for sure.
Fair enough, and I probably agree with you. Look, I like the story too. You know, the others, I probably just want to give them a little bit more time. This one I'm comfortably buying now.
I've watched all of these for years, and they all have a mixed bag in terms of management and stuff like that. And nobody's perfect, but these guys really do seem the best in management. Like, for example, I don't recall I think I'm correct to say, you know, the CEO never sold any shares, even when they got up to like 48 cents or whatever. She just rode it all the way up, wrote it down. I think she's in there for the long term, owns a decent chunk of the company. The sort of old founders are sort of handed over to her. She's sort of semi a founder really, because she was the CEO of some of the acquired companies that are making up what it is today. So good, honest alignment there, it would seem.
Alrighty, well, let's move on to my thought of the week. And I'm on the tech space as well. And I talked about it yesterday. I'm just got a feeling that we are on the cusp maybe of some recovery, a bit more stronger recovery that we've seen. We've seen some, you know, FOMO, a little bit of FOMO moves from the lows, people picking the bottom. But I think just having a look at what's going on with inflation, and it's obviously starting to peak. Maybe it's coming back down a little bit. Interest rates are rises starting to slow. So maybe there's going to be some interest coming back into the tech space. And one of the key factors for me for that to happen also is the results from the tech space, right? Especially in the US. Now, Microsoft last night came out with their results. And of course, this is one of the bellwethers in American NASDAQ space. They've come out with a pretty good market beating result, right? So they are after market now about 5%. So they're looking at about starting tomorrow at about 251, 252, somewhere there. So that's almost getting above those trends and starting to look like maybe a trend. You know, we're going slightly early. I understand that. So we're taking a little bit of risk. And this is not the story I want to talk about. I just want to bring you to your attention that I think what I'm just trying to think what's happening is that the investors out in the US may be a bit too negative on the tech space, and they're thinking they're going to come out and disappoint the market. Yet, in fact, they could be on the opposite side. In other words, they're going to surprise the market on the upside. So we've seen Microsoft do that. Great. That's a good start. You know, very early days, like I said, let's hope that my thesis plays out. If it does, the story I've got for you is XRO. Now,
that's good because I already own it.
Well, hopefully you're going to make some money.
Okay, so that would be nice.
But technically speaking, Claude, for you, it's starting to look much better, right? So at least it's probably a little head up above the trend lines. Like I said, you know, it's not ideal, it's not the best, but there is some movement. And I like the fact that they formed a bit of a base around that $70. And we talked about it together, Claude. We would rather buy this around 60, right? Or something along that. I don't think it's going to happen. So I think from now on, you'll probably be looking, if you're going to get onto this back onto this XRO train, probably in the 70s is your last chance. Let me go tell you why from the actual point of view of the results that they've had recently. So they did, you know, I think in November that this is the periods that they reached the results. So half year is on November, the full year is in May. So we've got about 4 months to go before we should see the full results. But if you read through the November stuff, there's a little bit of disappointment in there because the bottom line didn't equate to what the brokers were saying, right? Because they spent more to grow the business. But if you go through the numbers, extrapolate what's going to happen in the next half, they're actually talking about that there's actually improvement in the UK and there's improvement in the US. That's what the commentary was back in November. So I'm taking that line that I'm going with that, right? We're going to see, and they're still cash flow positive. It's not as if it's a business that's losing money because they can't, you know, the business is bad. This is actually a good business, but they're spending a lot of money to grow that business. And sometimes, unfortunately, maybe they just need to rein it in a little slightly, right? To just give it a bit more consistency, because it has been inconsistent. One quarter, 1.5, they are profitable, next half they're not. So from that point of view, I think overall, a great business. And I've just actually been using Xero myself, the accounting software. My God, it's brilliant. So I can imagine why people, like that sort of software. It's very sticky, difficult to sort of swap from one to the next, and they are growing. And they grew by about 30% last half. This is not a slow coach, even though it's a $10 billion company plus, it's still a decent clip business growing at a pretty quick base. Even if it drops down to 25 to 20%, it's still very, very good. So for me, this is a great opportunity, right? You've got things are turning in that space. So tech space, I think, is turning positively. Charts turning here as well. So you've got two things lining up, plus the results from previous November talking about positivity in the second half. So I'm going with that. I've got some tailwinds behind this, and I'm basically, nibbling on this, buying in this, and targeting probably the first thing I'm going to target around at $90 bucks. Even, I think it's doable, and even that probably 100 is even doable in a short-term basis. So this is not a bad little trade, and you've got to probably stop loss if you're going to be trading this. You've got to stop loss, let me see, around, you don't want to go back, 65, right? So not a bad risk reward here, but this is a long term for me. I think this is a great business. Maybe expensive. We'd love to buy it cheaper, but I don't think it's going to happen. I think we've past sailed that boat. If it was going to happen, it would have happened already, down to 60 bucks. It found a bottom. It's going up, and I'm buying this. So this is my thought of the week. And let's see what, how this sort of pans out, because I like your idea, Claude. I think, looking at the quarterlies, CDN looks pretty good. I might actually go and buy some more. And this one looks good as well for me. So yeah, let's fingers crossed for this one. Do you like my thought of the week for XRO? Does it make sense?
I quite like Xero, and I definitely think that you might be right. Like, we're definitely seeing risk on over the last couple of weeks. So like Xero's got come up a little bit, have you seen? But stronger movers have been some other growth stocks, like say Pro Medicus, which I own.
Yep.
That's really trading just off all-time highs now. So I think that is indicative of that sort of flow into the high beta tech stock stuff, getting a bit of flow back. Look, I think what can stop that, the risk there, what can stop all of these ones, is that you can have a situation where CPI comes in, a bit higher than the market's expecting. That flows through to increasing basically expectations around interest rates, either higher for longer or higher. And then that just gets that whole mechanism that we had throughout most of 2022, which is like, all right, well, put your discount rates up. That means your growth stocks are going down. And that could come back and hit Xero. And then the other longer term problem is that I think we've seen a slight derate from Xero, is that their most recent results were disappointing, showed a lot more expenses. Their expenses showing increased expenditure of revenue on product expenses with continue to increase there. This is indicative potentially of tech debt, whereby it's now a lot more expensive for them to improve the technology platform, because it's cobbled together in ways that don't allow it to scale and iterate very easily. So to change something, there are dependencies, so they then have to go back and fix other things. At some point, there's a low roadblock where it gets to the point where, if we want to fix this, we have to rebuild this whole thing, kind of thing. So it becomes very difficult and slow and expensive. I think that's what we're seeing with Xero in the most recent results. We're not seeing the company talk about that in any way. Look, it's consistent that a few years, 3 or 4 or 5 years after the founding CEO leaves, that's when you're going to get the issues with tech debt. Like, that's when the things that they did in a cheap and cheerful way that's good enough for now, that doesn't really scale properly, that's when it starts biting, because you're like, a few years later, you like want to change something, and now there are all these codependencies where you can't, or at least not without great expense. I have a suspicion that's where we are with Xero right now. Overall, because of those most recent results, I've been downgrading my view of Xero. I'm not an adder now after these most recent results, basically. But I do agree that for a short to medium term trade, this should be a decent one, because it is still a reasonable leader in that tech space.
Okay, well, thank you very much for that. Thank you guys for listening to us. Let's talk about, we're going to obviously get together again tomorrow, talk with Dave on Trade Watch. Thanks very much, Claude.
Thanks, Peter. Have a great day.
See you. You too. Bye.
Yeah.